Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. I'm your host, Chris Tennent-Brown, and joining me in the booth today is ASB Senior Economist Mike Jones. The government's recent tax changes to housing have come as a bit of a surprise to many, so we'll be chatting about what this means for our housing market outlook. We'll also be sharing our thoughts on the bond market and the continuing struggles of the New Zealand share market, and what all these things mean for local investors. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB who will be happy to chat if you need. Hey Mike, well welcome back to the booth. It's a bit's changed since we chatted a couple of months ago, and we're thinking about the outlook for the year, and probably the biggest surprise for me was the tax changes for housing which came about. They were a little bit more aggressive than I thought, and I thought it would be great to get you back and, amongst other things, chat about what you think about that and what it might have meant for your housing outlook, which was fairly upbeat when we were talking a few months ago.
Yeah. Thanks, Chris. Good to be back in the booth with you. And look, I'd be remiss if I didn't firstly congratulate you on becoming New Zealand's, as far as I'm aware, only economist/commercial pilot. So it's quite a diverse range of skills you're gathering.
Oh yeah, thanks for that. That's what's been keeping me busy for a couple of months, and I'm pleased to put the study behind me. In the end, I felt very similar to what I did when I was at university. In other words, I just hated myself because I'd spent so many hours and hours and hours just reading books and trying to memorize stuff. So it's good to be popping out the other side and turning back into a normal person again after all that study.
That was exciting. Is spending hours and hours on a plane, no doubt. So,
yeah, exactly.
I'm sure you'll be doing more of.
Yeah.
But anyway, housing. Yeah. So, some big changes. Some were a surprise in terms of some of the detail, certainly. But I think if you step back, in some sense, what we've seen is not all that surprising, given that the government was under a lot of pressure about housing. The housing boom had really got away on everyone, and what they've done is react to try and rein it in. And so that was always the risk. Really, we'd been flagging that risk that something was going to happen. No one, of course, knew quite what the announcements would be, but we were always going to see some sort of action, and we've seen that in terms of those tax changes.
Yeah, when we did the first bunch of analysis of what tax changes could do to property, I think we built a spreadsheet. It was back in the national government era, so it would be 10 years ago. And at that time, we thought any changes to the interest rate deductibility would probably be have the most impact. Is that how you feel now when you've been looking at things?
Yeah, there's a big impact coming through, and certainly it's been a happy hunting ground for spreadsheeters to get in there and put some numbers in and actually see what the impact is on the marginal investor. Our numbers say the impact is material, and without going necessarily into all the details, I think the key thing is that losing that deductibility will flip a number of investors into a cash flow negative position. So whether as before they might have owned a house that was sort of roughly washing its face, and as it went through time and allowing the capital gains to build up, now investors, particularly highly leveraged investors, are going to have to chip some funds in, i.e. that the house isn't washing its face anymore because of the loss of deductibility, and so that will mean some changes for some parts of the market, we think. So it's very difficult, of course, to translate all of that through into what does it mean for the macroeconomy, what does it mean for house prices across New Zealand. So we've made some assumptions on that front. But I think, the broader picture is one where we'd already started to flag. I think in March we sort of said, well, that's probably the peak in housing in terms of the growth rate of house prices. We thought things were likely to come off or slow down a little bit through this year. And so the changes that we've seen really just add a bit of punch to that view, really. So instead of perhaps a gradual easing in house price inflation this year, we think it's likely to be a bit more rapid. But, again, stepping back, big picture, we don't think prices are about to fall aggressively anytime soon. And so what that means is, if we're right in terms of our numbers and our forecasts, is that the big run-up we've seen in house prices in the past 18 months is largely going to be sustained. So that's So you have to remember that's still quite an upbeat sort of outlook for house prices. And the reason we're not sort of, I guess, bottling is that there's a number of the factors that drove house prices up to where they are now are still around, and the biggest one being a desperate shortage of supply and very low interest rates. And so neither of those factors have changed. Those are quite fundamental to the market. And so, we think there is still support there for house price inflation.
Yeah, and the other ingredient in there too is people are probably feeling a little bit more confident about their job security than even 6 months ago as the economy continues to recover, and that's a helpful thing as well too. One of the other things I've been thinking about is it might change things drastically for someone that was considering buying a rental property for the first time now. But for someone that's already got a portfolio of rental properties, then these changes take a while to phase in, don't they? And so it's not like suddenly the market's going to be awash with some people that are getting out of the market at all. So we're in that situation where, from a listings perspective, the housing market's probably still going to stay pretty tight, do you think?
Yeah, exactly. I think if we were thinking about a scenario where these changes might have a really big impact on the market and cause a big price correction, it would be under a scenario where investors exited. So there was a large scale selling of houses, and certainly offshore, that's the sort of thing you see that would catalyse a house price correction. But we don't think that's likely, and basically it's because if investors were all to sell a whole bunch of houses at once, the tax liability under the Bright Line test would be significantly more than the tax liability for staying in the market and losing your deductibility. Yeah. And there's also the other factor that we talk about CDB, which is, well, where are you going to stash all the money? Asset allocation in the current low yield environment is a bit of a headache. And so, if you're not owning property, where are you going to stash the cash? And there isn't any sort of obvious alternative with the likes of equity markets being priced relatively rich, and of course your income rate's very low. Yeah, and you're
going to pay tax on the dividend stream from shares, just like you're now going to pay a bit more tax from the property portfolio. Do you think it'll change people's attitudes to maybe looking at things like commercial property and some of the syndicated commercial properties that are out there that still seem to have the same tax scenario they had in the past?
Commercial property, I'm not as convinced. I think if you look at property investment in New Zealand, it's largely dominated by for want of a better term, the mums and dads. It's folk that own two houses, say their own home and one more, or maybe two rental properties. And so those sorts of investors are not particularly familiar with or have any material desire, I think, to broaden out into the likes of commercial property, which is really a whole different kettle of fish. And so New Zealand property investment's kind of unique in that sense, in that it's quite small in nature. We don't have the listed real estate funds and such like that you see offshore. I think what it might mean, though, is investors having more of a look at new builds, because obviously there's some exemptions there around the deductibility issue, and that reflects basically the government's stated aim to boost the supply and building of new homes. So there might be a bit more of a switch there, and we know new builds are coming onto the market at a pretty frenetic pace. But the interesting thing on that, I think, to watch is whether we see any crowding out effects from investors getting into the new build market, where has tended to be a first home buyer dominated market. At the moment, the share of first home buyers in the new build market is slightly ahead of investors. And so whether investors tilt into that market and push prices up will be something to watch, I think.
Yeah, that'll be interesting. And I think one of the things that when we got the LVR restrictions from the RBNZ since 2013, they were quick to adjust them when they thought this could be impacting the supply of housing in the market. That would be an undesirable consequence of the LVR restrictions. And likewise for the government, they'll have a lot of thinking to do to make sure that these rule changes don't have an unintended consequence, particularly if it slows down the overall growth in the pool of houses that are out there for people to live in, because that's the big problem at the end of the day, isn't it?
That's right. And it already there's signs of it turning into a bit of a whack-a-mole game with housing. I mean, it's such a complex issue, so you sort of solve one problem, but another one pokes out somewhere else, and you sort of rush to put a sticking plaster on that one. I think the governance needs to be, the benchmark needs to be, are the measures that are coming forward in terms of how do we solve and sort out the housing crisis going to boost supply? What is the ultimate outcome going to be something that lifts supply or restricts it further? And because that remains the number one issue. Investors, and it used to be offshore buyers, sort of get targeted from time to time for their participation in the market. But in some sense, that's just a symptom of the fact that we don't have enough supply in New Zealand. We don't have enough houses, and so we have these shortages that are quite pervasive and difficult to solve. And I think the focus needs to remain there and ensure that any of these new measures that are coming through are ultimately going to lead to some long-term improvement of the ability to provide housing.
Yeah. And if this all takes a little bit of froth out of the housing market and then in turn a little bit of the froth out of the growth outlook for the economy, does it change your thinking about what the RBNZ will want to do in terms of interest rates? It seems that the thoughts that maybe the RBNZ is a little bit behind and will need to be raising rates maybe early next year. There's no talk about that these days. What are you thinking with the interest rate outlook for the RBNZ?
Yeah, well, folk have backed off the idea, certainly, that the Reserve Bank was potentially going to lift interest rates as early as the first quarter of next year. I mean, that pricing had probably got a little bit away from reality anyway, and so those housing announcements have seen that push back. And certainly the Reserve Bank was under pressure on housing. There was a house price boom that in some sense was fueled by cheap money that the Reserve Bank itself was underpinning. So that's one less, I guess, headache for the Reserve Bank, to the extent we do see the housing market come off at least a little bit. But look, I think the broader issue in terms of central bank policy, including the Reserve Bank, has just been this global tussle that's emerged between central banks telling the market and telling analysts that, look, they're not thinking about pulling away the punch bowl for a long time, and everyone to just go back to watching the data and chill out for a bit, to fixed income investors going, well, I'm looking at some pretty rapid inflation increases coming through in pretty short order. We're seeing boom-like conditions in parts of the global economy. It's a bit pockmarked in terms of how the recovery's been, but the US is expected to grow 5-6% this year and next. China still up around 8-9% rates of growth, and so investors are kind of going, well, this is going to cause inflation pressure. We're seeing commodity prices bounce quite aggressively. Iron ore prices overnight hit a new record high. So there is going to be some inflation coming through, and the question is going to be, well, are central banks going to react to that or not? Central banks are saying no. The markets are saying, well, yes, you are, and there's this tussle going on. So I still think, housing aside, or our view remains that the Reserve Bank's probably going to have to start reducing stimulatory monetary policy a little bit earlier than it perhaps would like to do, and that's because these inflation pressures are here. We think, as you mentioned, labour markets are improving at a rate of knots that have been quite amazing, really, and certainly faster than central banks have expected. Unemployment in the UK is now below 5%. It's below 5% here in New Zealand. It's at 5% in Australia, and the recovery in those markets has been remarkable, and that's going to bring about some wage inflation too. So that's another dollop of inflation pressure on the heap for central banks to have to think about.
Yeah, so at some stage they need to react, and investors need to react in the sense that if you were getting, say, 0.5% for a 10-year government bond like September last year, well, that was never going to keep pace with inflation, even when it was at its lows. But now that we're starting to talk about inflation of a couple of percent, maybe even a bit more, or even on target inflation, interest rate markets seem to be adjusting, and we've seen a big step up in rates over the last 6 months when we're moving away from central banks and talking about 5 to 10 year bonds, and we're seeing it in our portfolios. And it's tricky for people to get their heads around, but the benchmarks and people's bonds within their portfolios have gone down by 1% or so, not because there's a credit event, but just because we've seen this upward adjustment in interest rates, and a downward adjustment in prices. So it seems there's a lot happening in the bond market, and that'll be an area to watch over the next year or so.
Yeah, I think the key thing is really, is this pickup in inflation going to be sustained, or the start of something broader, or is it just temporary, like central banks are telling us is the case? And so for the bond market, that is, I think, the number one question for this year. And I think the second half of the year will be pretty telling in that respect, when we start to see this, the numbers reflect what has been a turnaround in economic activity that began last year, and what it's all meaning for inflation and wage inflation in particular. And of course, what happens in the bond market with respect to interest rates will have implications for other markets, share markets being one. And I guess we've started to see share markets pay a little bit more attention to what's been going on in bond markets in the last 6 months than we have, perhaps over the last few years.
Yeah, I think one of the things which we talked about quite a bit when the New Zealand share market was going well was the fact that it pays a decent dividend, and there's a lot of stocks that are paying over 4% dividend yield, and that's pretty appealing when term deposits or government bond yields are down around 1%. But when they start to lift like they have done, people will ask the question, well, where might this stop? I'd take 4% from a government bond before I took it from a company in terms of a risk return. So where we think things might settle for those yields is really important for investors that are making those sorts of trade-offs. But I think it's going to be an interesting time. So far, it looks like the central bankers have been talking very dovish and trying to avoid some sort of taper tantrum like we saw back in the Bernanke era when markets really panicked just at the mention of winding back stimulus. So hopefully we can continue to avoid that sort of thing.
Yeah, it certainly seems like they've all been singing off the one song sheet which they've been passing around the world, sort of saying, look, don't get ahead of yourself, everything's fragile, inflation's temporary. We're seeing that mantra rolled out a lot. We did see, interestingly, maybe the first signs of one bank breaking ranks last week, which was the Bank of Canada, who for the first time kind of acknowledged that, well, yes, we might be past the worst here, and ultimately interest rates will have to rise at some stage. And in fact, I can't quite remember, but might have actually explicitly forecast that happening. So, I mean, that was interesting for me. Whether or not that's the harbinger of more central banks doing the same, but we'll just have to watch how things pan out in the next few months.
And be doing a bit of explaining about what's going on within the bond funds to our investors, I imagine. So, yeah, a bit of work to do there. What about some of the other things the Reserve Bank's doing, like the large-scale asset purchases and their funding for lending programs? How do you think they're working?
Yeah, it's hard to observe them working directly. They're sort of quite mythical kind of beasts for the average investor or person on the street. They're difficult to observe, but they are working. What we've seen is, as we've talked about quite a lot, very steep increases in wholesale interest rates, not just in New Zealand but around the world, which you would normally expect to translate through to increases in retail rates. But there is a bit of a blunting mechanism in place, which is, variously the other stuff that the Reserve Bank is doing, whether it be buying bonds hand over fist still, or other mechanisms like the FLP, the funding for lending program, whereby the Reserve Bank directly lends to commercial banks at low rates of interest. So there has been an impact there, definitely in holding the likes of mortgage and business rates down lower than they would be otherwise, perhaps. It's always very difficult to figure out just how much. And the other impact, of course, is probably on the exchange rate, which, as the Reserve Bank has said, is trading lower than it would otherwise be if the Reserve Bank here was not doing quantitative easing or buying bonds, although, again, no one knows by how much. But, on that score, I mean, it's interesting to me that, as I said before, iron ore prices are now higher than they were in 2011. 2011, the Aussie dollar was trading at, $1.10 against the US, which is, somewhere around 30 or 40 cents higher than where it is now. So there is some impact, clearly, from other things.
And the same here. We just bumped up our dairy price forecast for next season, and we're going to get milk price payments to farmers somewhere north of $7.50 this year and next based on our forecast, which is just a great outcome. But again, for the Kiwi, we were knocking around, I think, 88 cents or something like that against the US dollar when we peaked, and here we are in the low to mid 70s. So there is some positive impact, which is helpful. But it's like if everyone's doing this quantitative easing, we all have some sort of impact on our exchange rate. But at least Australia and New Zealand's dollars aren't going crazy and wrecking those good global export price stories.
Yeah. And what about for the share market? I mean, that currency that's, I guess, been rising but is lower than otherwise. Is that sort of helping some of the earnings in terms of our export-orientated companies? Yeah,
I think it's been an interesting story there. I've kept a close eye on Fish and Paykel Healthcare. They just had such a phenomenal period of earnings upgrades, and then their share price started to come in a bit of downward pressure with as it looked like, hey, the vaccines are going to start to work, and the year ahead will probably and hopefully not be as busy for them as COVID's behind us. But now we've got this sort of third wave and clearly huge numbers of cases in places like India, and their share prices come back up. And so, the exchange rate's important for companies like that. We've mentioned Fonterra. I guess more broadly, rather than the exchange rate, the thing I've been interested in the share market is what does the outlook mean for some of the stay-at-home stocks that have done well and some of the healthcare stocks that have done well over the next couple of years when hopefully COVID's behind us. But this latest wave and the lockdowns again in the Northern Hemisphere has perhaps pushed pause on that rotation for now, but I think that'll be a thing to watch in the share market beyond how the currency's going. And the other thing which is hard to avoid here is this story with the electricity stocks that just rocketed away late last year, and as they got included in these clean energy indices or exchange traded funds, and then came back down when the benchmarks were adjusted. So those have been some pretty big themes that have been playing out in the New Zealand share market, as well as the usual macro stuff of low interest rates and a reasonably favourable exchange rate.
Yeah, and then so just to put you on the spot here, I mean, what's your sense? I mean, there's been a little bit of chatter about why the New Zealand market's kind of, I guess, underperformed when you look at some of those offshore stock indices, like, for example, the S&P 500 and the NASDAQ hitting, fresh record highs most days at the moment. I mean, are those gentailer stocks part of the story there, or? Yeah,
and you could add the Aussie market. That's gone better than our market too. And the one big part of the story there is Aussie's got a lot more exposure to those hard commodities. And iron ore in particular, that's helped their market. But a big thing there too is the financial stocks in the Aussie market that make up a big chunk of their index. And this global recovery theme, combined with the low interest rate environment, has been pretty supportive for those stocks too. So there's a few reasons of what's in the New Zealand market, particularly those electricity stocks, that are behind the underperformance, and also what's not in it, such as the big smattering of financial stocks that have led to some differing performance. But one of the things I think that's really useful to do at times like this is to look at it and go, well, actually, we're just back to where we were in November on those electricity stocks. And so there's a little bit of a theme of, hey, there's been some volatility in there, but actually if you look at the longer picture, things are actually on a reasonable track here. A little bit like the bond market, maybe yields got pushed too low around September last year, and we've got some payback for it now. Same within the share market. If we look at values probably got pushed too high around the Christmas period, and now we're back to more like where we think we were. And there's other stock specific stories in there as well. But overall, I think the market's functioning pretty well. But it is really unusual because we've had quite a few years where the New Zealand share market's just steadily outperformed other markets, and so we're in an unusual position to be lagging. But hopefully over the year ahead, things will even out. The other thing which is a little bit tricky at the moment is if you look at annual performance, it looks staggering. But that's, of course, because we're going back to start on the 1st of April 2020, and we capture all but a week of the share market recovery. Markets were at their low point in around 23rd of March. So it's actually really hard to look through the noise and get a good steer on performance these days. And I think that'll be the case for a while because there's all these unusual events to ponder. But for people that are interested in that, I try and make heads or tails of it each month in my Markets Monthly report. So that's one place to start to try and keep track of it.
It does highlight for me, just as you were talking then, CDB, notwithstanding the fact that those annual growth rates are overstated because of the base effects this time last year, but it does highlight the fact that the share market is still performing, oftentimes, and including in the past year, performs that much stronger than a lot of other asset classes, notably housing in New Zealand, for all the attention that housing gets understandably, for growing, up close to 30%. Well, what's the annual rate of growth in the share market?
Oh, you would have been pretty brave to drop some money in the share market or the housing market in April last year. But if you did, you're going to be up 30%. And 50% in international shares. So phenomenal growth there. In those markets, and so yeah, you're right. But people often don't look like that, and we try and encourage people not to get too enthusiastic about very short-term returns. But the return on growth assets has been pretty amazing. And if we look over 5 years to the return in the New Zealand share market's well over 10%. So it's a pretty strong return. That's for sure. And hopefully we'll continue to see some reasonable performance over the years ahead, but it wouldn't surprise me if we see a bit of volatility as we go through all this uncertainty, and particularly with those interest rate adjustments. Hey, so obviously that's going to be something that I'm going to be watching. The reporting season in the States at the moment is pretty important, and definitely I'll be keeping a wary eye on the bond market. It actually looks like it's paused a little bit over the last month or so. That big rise in yield seems to have stopped and actually gone sideways for a month or so, but I'll be watching to see if that picks up again. What sort of things are you going to be keeping an eye on over the next couple of months?
Well, I'm looking forward to watching the cricket, actually, CDB. So
fair enough. Yeah, hopefully they all get there.
If I can sidestep markets for a moment, the Kiwi cricketers heading off to England and then playing the World Test Championship final against India. That's going to be pretty exciting for me. But in terms of markets, look, I think it's. I think, and we've talked about this earlier in the podcast, but I think the number one question for financial markets, which has implications everywhere, is really when does the punch bowl get removed by central banks, and for that we need to look at where inflation does print, and so it's going to be interesting to see how that goes in the next wee while. My sense is it's going to come in above where central banks and many have been expecting, and so what. That's going to test the mettle of central banks in their communication, whether they can weather that and keep the faith that it's a short-term spike, or whether they are. We do have to think about signalling the end of stimulatory policy sometime down the road. And aside from what I'm watching, the other factor I've found quite useful and telling in the post-COVID era, since we're calling it that now, is just talking to firms, talking to businesses, because the information we've been able to get in terms of how firms are seeing things is both obviously very timely compared to looking at the data, and has proved to be quite prescient. I mean, the feedback I got quite early on, I guess winter of last year, was that no one could quite believe how well or resilient their firm had been against the various predictions of doom and gloom that were coming out as a result of COVID. Sort of cautious, but at the same time kind of pleasantly surprised, and that's kind of being borne out ultimately in some of the data as in terms of how well the economy has performed. And what they're saying now is basically they're really struggling on a number of fronts, struggling with capacity and shortages of goods for those where certain imported components are key parts of their supply chain. They're seeing that being manifest in terms of cost and price increases, and they're also really struggling to get staff. So that's another, shortage, if you like, shortage of staff, which is being manifest in wage increases. And don't see a lot of, from what I've heard and seen, any relief on the horizon, at least in the short term. So, that's some real, I guess, growth challenges for the economy this year, and also some upward pressure on inflation as well. So, I'm enjoying getting out and talking to firms, and we'll just have to see how that whole kind of thematic evolves in the next few months.
Yeah, when you say that, it reminds me of basically what we would have been talking about if we thought, what does the year ahead look like if we'd been having this conversation in December 2019. We were worried about a bit of a sugar rush in the housing market and how that could get reined in. We were worried about a low unemployment rate and what that might mean for firms to be able to expand. And we looked at the sectors that should go really well, like construction, and think, well, you're already going gangbusters. It's pretty hard to imagine you growing any more. So rather than being a monstrous game changer, there's some parts of the economy that are really just now back to facing the same problems they were facing 15 months ago. And that's something that none of us really expected, but actually we've just gone back to the things that we were worried about back before all of this pandemic changed our lives so much.
Yeah, that's right. And it sort of relates to something I've been thinking about for, what kind of the likes of ourselves and economists kind of missed with COVID, which was, it wasn't the game changer, as you rightly said. It wasn't something that turned the cycle. It was more of a pause. It paused the cycle, so it paused the inflation cycle, the house price cycle, potentially even the labour market cycle. I mean, people thought, well, this is going to be 10% unemployment. This is going to be no wage growth for years. Blah blah blah. So instead of tipping all those markets over, share market included, it was more sort of we hit pause in the true lockdown sense of the word for a few months, and most of those markets more or less resumed where they left off, which is a generalisation, sure, but it hasn't been quite the cycle tipping game changer that we might have thought. It's, Yeah.
Well, hopefully
we're back talking about what we were talking about.
Yeah, the economy can pick up where it left off, and hopefully the New Zealand cricketers can pick up where they left off and keep on just really going incredibly well. So we'll both be looking forward to that, as I'm sure lots of our listeners are. Hey, thanks for joining me again, Mike, and I'll really look forward to catching up again and seeing how some of these things pan out.
Pleasure as always. Thank you. Thanks, Chris.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.